Home values fell in 27 states last month, and nearly 500,000 more sellers than buyers are in the market. That's a new record. Real estate guy Mitch Rochelle, is that a glimmer of hope for values down in 27 states, more sellers than buyers? Is that a hopeful sign?
More sellers than buyers, supply and demand. That's why values are falling on the margin. But if you're a home buyer and there's more homes on the market, that's a good thing, right? The issue that has plagued this housing market is a lack of supply of homes. So the fact that we're seeing people put their homes on the market and there's homes that are actually available to buy, I think that that's a good thing for the industry. And if that trend continues, then there's, homes for people to buy. And if prices are falling, that means the first-time home buyer may have a shot at that home.
That clip makes it sound like a healthy housing correction, right? More listings, prices cooling, maybe the first-time homebuyers finally catch a break. And to be fair, that's partially true. Inventory is rising, prices are slipping on the margin. But let's not confuse this with a healthy correction. What that clip really signals is that sellers are rushing for the exits. The lock-in effect that froze the market for the last 18 months, it's breaking and fast. And a lot of those listings, they're heading for the woods, trying to exit near the top before things really flip. Because the bigger picture is turning. Affordability has collapsed, buyers are priced out, now sellers are cracking. Home values just dropped in 27 states. And for the first time since 2013, sellers outnumber buyers by 500,000. Zoom out, and it's not just housing. Delinquencies are rising, bond yields won't break, tariffs are whipsawing markets, and credit's tightening in the background. If, like me, you've been sensing something is off beneath the surface, you're not imagining it, and you're definitely not alone. So here's what we're unpacking in this video. The housing rollover that's flying under the radar, full market recap, delinquencies rising, bond market whiplash, tariff chaos, and credit stress, my trade breakdowns, what worked, what didn't, and how I managed risk this week, my full technical analysis, key levels I'm watching, patterns I'm trading, and traps I'm avoiding, and the big catalyst for next week, from jobs data to Fed speakers to high impact earnings. Let's jump in. Let's start where the real pain is, the housing. Last week, we flagged the early signs. Affordability collapsing, 70% of Americans priced out of $700,000 homes, 53 million households unable to afford even 200,000 listings, inventory up 17% year over year, which is the highest since 2020. We said the lock-in effect was starting to break. This week, that break turned into a shift. Home values declined in 27 states, a clear sign that prices are finally giving way. And more importantly, for the first time since 2013, sellers outnumber buyers in the housing market by more than 500,000. That gap matters. It's not just distressed sellers behind it. Many of these listings are likely strategic exits by homeowners who sense a turning point and want to get ahead of it. In my opinion, this isn't panic selling, it's positioning. A lot of those homeowners likely have cash reserves. They're listing now, aiming to sell near the top and then re-enter when prices reset. That's not desperation. They're getting ahead of the market they don't trust to stay stable. And yes, I live in LA, so technically none of this applies here. Our housing market is still operating in its own alternate reality where tear-down bungalows list for 1.6 million and sell over asking in 3 days. But nationwide, that seller surge isn't optimism, it's a warning. While financial media frames it as good news for buyers, it's really a flashing signal that housing momentum is rolling over. This is late cycle behavior. Now, zooming out, the consumer stress is escalating. Credit card delinquencies just hit 12.3%. Student loan delinquencies are up to 7.7%. And mortgage, auto, and HELOC delinquencies are all rising. We also jobless claims hit their highest level since 2021. Continuing claims are climbing, signaling people are staying unemployed longer. And that's not a healthy trend, it's a slowdown. Meanwhile, personal income came in hot at 0.8%, but spending was flat. That's a caution flag. Consumers are pulling back. Core PCE was flat, but headline PCE came in slightly cooler than expected. Disinflation? Maybe, but not enough for the Fed to move. Speaking of which, Powell sat down with Trump this week and basically said we're not cutting just to make you happy. No forward guidance, no promises, and definitely no pivot. Bond yield spiked briefly. The 10-year hovered above 4.5%, and a 30-year flirted with 5%. The 5-year Treasury auction saw strong demand, which is typically a defensive move. The yields came down later in the week. Meanwhile, credit default swaps on US debt surged, a clear sign that investors are getting nervous about credit quality, even as other parts of the market keep drifting higher. Even Jamie Dimon warned we're going to see a crack in the bond market, and he didn't even stop there. At the Reagan Forum, he said China has its own issues but also does a lot well, and made it clear that his bigger concern is America's internal problems, our leadership, our values, and our management. In his words, the real threat is the enemy within. When Jamie Dimon, the CEO of the largest bank in the US, JP Morgan, starts pointing fingers inward, it's worth paying attention. He also backed the Fed's approach, saying they are right to stay patient and not rush into cuts, and even said he's prepared for 5% raise to stick around. And while we're quoting Jamie Dimon, here's the stat that might explain part of his concern. 20% of all US government revenue is now being used just to pay interest on the debt. If you think that's sustainable, you might be dumber than someone who thought NFTs were the future. Meanwhile, the White House is trying to calm nerves by claiming Trump's new tax bill won't add to the deficit. But analysts disagree. They estimate it will add $3.8 trillion in debt. The bond market isn't buying the optimism either. Zooming into tariffs, we saw total chaos this week. The federal court initially struck down Trump's Liberation Day tariffs, calling them executive overreach, triggering a $10 billion in potential refunds, including $3.5 billion back to China. Markets cheered initially. S&P futures briefly touched 6,000 in after hours on Wednesday, but 48 hours later, the appeal court reversed it. Tariffs reinstated, then Donald Trump doubled down and raised steel and aluminum tariffs to 50%. A few notable earnings dropped this week, and one that really stood out was HP, and not in a good way. They slashed full-year guidance and blamed tariffs, China exit costs, and supply chain stress. The stock dropped 14% after hours. Meanwhile, NVDA posted blowout earnings. Revenue is up 69% with $44.1 billion overall and $39.1 billion from data center. Adjusted EPS was at 81 cents, but it would have been 96 without the $4.5 billion China-related charge. Forward guidance is at $45 billion for next quarter. But here's the kicker. Jason Huang immediately filed to sell $800 million in shares. That raised eyebrows, especially because institutional positioning is going the opposite way. Fund managers are underweight equities. Hedge funds are loading up on credit default swaps and shorting high beta names. According to CFTC data, institutions now hold the largest short position in over a decade, and yet retail is piling in. This week, they added $6 billion into stocks, chasing the bounce while smart money faded it. CEO confidence also fell off a cliff. Largest quarterly drop on record. Sentiment is now near pre-recession levels. On the global trade front, US and China tensions worsened. Trump accused China of violating the trade deal and vowed to get tough. Talks stalled. The White House is considering more direct diplomacy between Trump and Xi. In the meantime, new chip sanctions are in play, targeting NVIDIA, AMD, and Qualcomm. The Office of United States Trade Representative called China's behavior unacceptable. We're seeing signs of full breakdown. Also worth noting, while everyone's watching these headlines, few are paying attention to one quiet but massive risk. Asian nations now hold $7.5 trillion in US assets. That's serious leverage, and any shift in capital flow could have real consequences. And if you thought that was already enough bad news, we've got even more escalation. The US Defense Secretary now says China is credibly preparing to use force to alter the balance of power in the region. The administration believes the threat is real and possibly imminent. This may explain the sudden rise in trade tensions and market volatility over the last 48 hours. Whether it's economic war or geopolitical posturing, this isn't calming anyone down. And it wasn't just sentiment. The hard data is starting to fall apart too. Imports fell close to 20% year over year, the largest drop in US history. It's not just a trade war effect, it's a demand signal. And when imports collapse, it tells you that consumer activity is drying out fast. Oil could also become a pressure point. OPEC Plus is planning another production hike in July. The last hike in April already crushed the energy sector, which is down about 13% this quarter alone. Crude may drop another 10% if this new hike sticks. And yet, the Atlanta Fed's real GDP tracker, basically their running estimate for how fast the economy is growing, jumped from 2.2% to 3.8%. That's a big move and kind of confusing given everything else we just covered. In my opinion, this spike is likely a blip driven by front loading. With new tariffs looming, both consumers and businesses rush to pull demand forward before price spike. It boosts the data in short term, but it doesn't reflect sustainable strength. It's a sugar high, not a real growth. Alright, let's talk about my trades. I made a few trades this week that didn't work out. The biggest one was the SPY 580-575 put spreads I opened last week, looking for a breakdown into 575 or lower to fill the gap. That setup never played out, and the spread expired worthless on Friday. That was the bulk of the damage. I also opened a new SPY 585-580 put spreads for next week. This one's based on head and shoulders pattern forming on the 4-hour chart. Neckline is around 585. If that breaks, I still think we could see the gap get filled. I won't be making the same mistake. I'll be managing this one early in the week. Outside of that, I opened HIM's 50-45 put spread for June 20th. Weekly momentum is fading and I'm targeting a move into the 46 area. But as a contrarian, I'm also open to the idea that HIM's could be forming a cup and handle formation. If we break above the handle, I'll close the trade for a loss. At that point, the setup would no longer be valid. All in all, this week ended red, down over $3,500, all short term. Not ideal, but I'm sharing it because this is part of the process. Not every setup works, not every week is green. What matters is the risk was defined, the position size was right, and I'm still positioned with capital on the sidelines heading into what could be a volatile stretch. Alright. Let's jump into the chart setups I'm watching this week. This time, I'm starting with the 4-hour chart of SPY. I flagged this on Twitter too. We may be forming a head and shoulder pattern. The neckline is around the 585-586 zone, but we need to see a close on the 4-hour chart. To be a little more conservative, you could wait for a close below the support line at 584.15. If that breaks, the next stop is around 580 as a soft support, followed by 575 as a more critical level. I'm already in the 585-580 put spreads expiring next Friday. That trade gets invalidated if we break above 595. On the daily, we've been stuck in a yo-yo pattern, lots of chop and big wicks. These kinds of candles usually show up during distribution or accumulation phases, where buyers and sellers are battling it out. The MACD has flipped bearish, but there's not much momentum yet. If we lose 584.15, I think we'll have formed a clean double top and could be on our way to retest the 200-day moving average again. Will that level hold? Who knows? But my bias is still toward the gap fill happening before we see new all-time highs. Now watch me eat those words later. Looking at the daily S&P 500 futures chart, it's very similar story to SPY. We've now been rejected from the 6,000 level twice. So it might just be start of a double top pattern. The neckline is down at 5,773.75, which is now sitting just below the 200-day moving average. The MACD is red here too, showing a loss of bullish momentum, but we haven't seen real bearish momentum kick in yet. If we lose the 200-day moving average, I'll be taking much bigger bets against the indices and gunning for those gap fills. I also want to look at the weekly chart. We're above the 50-day moving average, which is an important indicator to watch for. If we close below this level on the weekly chart, then we're definitely heading lower, no question about it. MACD still looks bullish on the weekly, but let's be real, we've failed to break and hold above 6,000 level for 3 straight weeks. Could this be a bull flag? Absolutely possible, but I want to see a confirmation. A close above 6,000 likely takes us straight to a retest of the all-time highs. A break below 5,773.75, which again lines up with the 50-week moving average, would confirm this was just a bull trap and lower we go. The daily setup for triple Qs and Nasdaq futures is almost identical to SPY and ES. The one major difference is that the 200-day moving average is a bit further away, meaning tech has more room to fall before hitting major support. At this point, triple Qs and Nasdaq futures will just follow whatever S&P does. If you're trading either one, S&P is the one to watch. Also worth noting, MACD on both the Qs and Nasdaq futures have crossed into bearish territory. It's not panicky yet, but the signals are flipping. Looking at VIX on the daily, we've just been coiling. MACD is showing bullish momentum, but nothing spicy just yet. Seasonality-wise, this time of the year tends to be quiet. But with everything else we've talked about, housing cracks, credit stress, tariffs, yields, and so on, I wouldn't be shocked if VIX breaks higher instead of fading. And honestly, with volatility this low, now is the best time to buy puts. Downside protection is cheap, and don't wait until everyone is panicking. IWM is still the laggard of the big indices. MACD is bearish, and we've been having a hard time closing above the 100-day moving average, the purple line. Some traders might see this as a bull flag formation. For me, a break and a close above the 210 would be confirmation the bull flag is playing out. Tom Lee even said that small caps could shine later this year. So maybe he watches those breakdowns too. Who knows? Jokes aside, it feels like momentum is fading here. If we roll over, I'm watching the 50-day moving average as the next real support. Now onto NVIDIA, looking at the daily chart. Last week, I said a close above 136.73 on the weekly chart would open the door for higher highs. That didn't happen. The stock spiked post-earnings, but quickly faded back into pre-earnings levels. I even tweeted that market makers were pricing in no move. And by the end of the week, that's exactly what happened. We closed flat. I didn't trade it, too much premium priced in, and the options market wasn't offering any edge. If anything, the best play was to sell this week's options and by next week's to catch the volatility fade. The bigger issue now, that post-earnings sell-off, if investors were confident, we wouldn't be fading this hard. MACD is about to flip bearish and RSI is rolling over. And let's not forget, Jason Huang just filed to sell $800 million worth of NVIDIA stock. That's not exactly a bullish vote of confidence from the CEO. That's just my 2 cents. I'm just a guy on the internet with a decade in risk management. But if the biggest insider is dumping, I'm definitely not buying. You, do your own research. The daily chart of Tesla is, well, doing Tesla things. Last week I mentioned we were consolidating between 350 and 325 and possibly forming a bull flag pattern. A break above 350 would open the door for a breakout, and we got it. Price popped up to 365, but then gave it right back and fell back under 350. Structurally, we're still in an uptrend, but the MACD is starting to lose steam. The RSI is also rolling over. Keep an eye on that yellow upward trend line. If we lose that, it likely signals a new wave of price discovery to the downside. The real line in the sand is 325. If that breaks, we're probably heading down towards the 200-day moving average. As for me, I'm staying on the sidelines for now. No certainty here. If I'm not confident, I'm not trading it. Apple is still the worst performing name in Mag 7. We traded it last week for good profits or amazing profits if you held it longer than I did. But now it's getting harder to read the tape. For almost 2 months, the price has been sandwiched between 213 and 193. MACD is starting to show signs of flipping bullish. But without a follow through, I don't see this moving much higher. We've been printing lower highs, and it's very possible we just made another one on Thursday. Unless Apple can take 212 with conviction, I'm staying away from bullish bets here. And with all the new China escalation we just covered, this chart may have more room to fall. On the daily chart of crude oil futures, we lost the key 61.55 level, and honestly, I think that the ABC pattern might not play out this time. Momentum is fading, MACD is about to flip bearish, and with OPEC Plus potentially boosting production next month, this is setting up for lower oil prices. We've got support around 58.25. If that breaks, the next target is 54.25. But remember what I said in last week's video. If we dip back into 58 and catch a support, that opens the door for a potential inverse head and shoulders pattern. So we're not there yet, but that's a structure I'll be watching. On the daily chart of the US dollar, we've been consolidating for a while now, just chopping around. But once again, we got rejected of that downward sloping trend line with a big fat bearish engulfing candle. To me, that says we're probably heading for lower lows. Yeah, the MACD is starting to curl back up and show signs of flipping bullish. But given the macro dumpster fire we've been watching unfold, I still think the risk is to the downside. And remember, any escalation in the tariff rhetoric will force investors to start dumping US equities and assets and go hunting for shelter elsewhere. And yes, the US dollar will absolutely be on that list. Unless we break and close above that yellow trend line, the sentiment stays bearish on the dollar. On the daily chart of TLT, we finally broke above the downward sloping trend line. The MACDs flipped into bullish momentum. So far, so good. And if you squint hard enough and maybe tilt your head a little too, you might even spot an inverse head and shoulders pattern trying to form. The key confirmation is a clean break above the neckline around 87. Until then, I'm not really touching this. It's too early to chase. A failed breakout here would just trap a bunch of eager longs and dump us right back into chop. But given how fast the macro flipped this week, from tariff chaos to bond-friendly headlines, we could see real volatility hit the bond market. Don't get too comfortable just yet. Looking at the daily chart of the 10-year yields, we're forming a head and shoulders pattern, which is not surprisingly is the inverse of what we've been seeing on TLT. I'm going to be more conservative here and say I want to see a clean break and close below 4.37% before jumping into any TLT longs or yield shorts. No guessing games. The MACD is already in the bearish momentum, which definitely supports the case for more downside, but confirmation is key. Keep your eyes on that level before getting cued with bond trades. Let's see what other crazy macro headlines or reports we'll get next week. With that being said, let's take a look at the key economic and earnings reports for next week. Starting with Monday. On Monday, we have ISM manufacturing PMI, construction spending, Fed speakers including Jerome Powell. On Tuesday, we have factory orders, JOLTS, job openings, and more Fed speakers. On Wednesday, we have ADP employment report, ISM services PMI, and Fed beige book. On Thursday, we have initial jobless claims, final productivity and unit labor costs, trade balance, and Fed speakers. And finally, on Friday, we have non-farm payrolls, unemployment rate, and average hourly earnings. This week, the volatility risk is high. Any miss in payrolls or ISM could break the sentiment really fast. Now, heading into earnings, we don't really have anything big on Monday. On Tuesday, we have Dollar General, NEO, CrowdStrike, HP Enterprise, which includes the IT and cloud infrastructure. We got the PC and the printer business earnings report last week, and the stock dumped massively, as I mentioned earlier in this video. On Wednesday, we have Dollar Tree and some other names. On Thursday, we have Broadcom, DocuSign, Lululemon, Petco, and Service Titan. And finally, on Friday, we have Jill and Fuel Cell Energy. So, to recap, we've got cracks forming everywhere. Housing momentum is rolling over, consumer stress is rising, delinquencies are ticking up, and jobless claims just hit their highest level since 2021. At the same time, bond yields spiked midweek on tariff chaos, then pulled back as volatility crept into the fixed income. All of this is happening while retail piles into stocks, institutions hedge, and GDP forecast somehow jumps to 3.8%. Let's be honest, this market isn't being driven by technicals or fundamentals right now. It's being driven by whatever headline comes out from the White House next. You can chart the cleanest setup in the world, but if the administration reinstates tens of billions of dollars worth of tariffs before mid-morning, that whole plan goes out of the window. DC is clearly steering the market more than the Fed, the data, or any chart pattern. And if you're feeling whiplash, you're not alone. This is late cycle behavior, fake confidence, sharp reversals, and non-stop headline landmines. You've got to stay tactical, define your risk, and be clear about what's real and what's just noise. Here is what I'm personally watching. Does the 10-year hold above that key 4.37% level, or crack below and give us a real bond rally? We get more trade war fireworks and tariff drama that force investors to reposition again. Can semis and mega cap tech keep carrying this market, or does leadership start to rotate? And are institutions still hedging aggressively while retail chases the rally? There is a lot that can shift fast, and if you want to stay one step ahead, get on that free newsletter, the link is below. That's where I break down all this with charts, trade setups, and macro notes before the next video even drops. If this video helped make sense of the chaos, tap like, subscribe, and let me know in the comments what setups you're watching. And as always, please protect your capital and stay nimble. Thanks for watching, and I will see you in the next one.